Hello, viewers. I welcome you all to this special session on electricity derivatives. As you all know, recently on 10th of July, MCX had launched electricity futures, and today we'll be discussing in depth, in detail, what are all the contract specifications of this particular futures contract, how the contract works, how the prices are derived, and all those things. And as you all are aware, every month, every Thursday at 4 p.m., we dedicate at ICICI Direct 1 hour for commodity derivatives. First Thursday of every month, we discuss the basics of commodity derivatives overall, the commodity derivatives market. And the other Thursdays, we run the series called Insights, Trends and Forecasts. उस series का almost 25 episodes हमने complete कर दिया है. But for this particular month, July May, since we got an fifth Thursday, a bonus Thursday kind of. So we thought we will come up with a special topic, and that's why today here we are with this topic of electricity futures. And to take us through the session, we have a special speaker with us, Ms. Ruchi Shukla, who is the head of energy segment at Multi Commodity Exchange of India Limited. So Ms. Ruchi was played a major role in the launch of this energy futures contract. So आपने हमारे previous sessions में देखा होगा, we usually discuss gold, silver, crude oil, natural gas, फिर aluminium, copper, ये सब discuss करते ही है. Some of those contracts, some of those commodities we relate on a personal level. Gold and silver तो हम personal level we price tracks, we relate to those prices, price movements. Even crude oil and natural gas we trade regularly. Even if you see at MCX, one of the highly trading commodities are these crude oil and natural gas, for example. So in this energy segment itself, particularly, we have one more contract added, one more commodity added, which is this electricity. For now, we have launched, MCX had launched only electricity futures. So I'll give you a major understanding, a basic understanding how this session will go on, what the flow will be. So particularly for this electricity futures, Ruchi ma'am will be taking us through the spot market, like from where the prices are derived, what are the underlying spot market from where the prices are derived for this future market. It'll be interesting for you to understand because all other commodities we are tracking from international exchanges. So international exchanges से हम prices derive करते हैं, but particularly for this electricity, it is completely an Indian market, an Indian product. इसका spot market will be an Indian spot market only for electricities. So ma'am will be explaining you that. So पहले spot market समझ लीजिए. Going ahead, ma'am will explain the contract specifications, particularly of this future contract, which is being traded on the MCX exchange. And going ahead, spot market and future market का MCX का some websites will go ahead and see कि कैसे prices कैसे दिखते हैं अभी कैसे आ रहे हैं. Will just get an idea of how the prices are moving and कितना margins लगेंगे and all those things. Also, ma'am will be explaining you the key factors that are impacting these electricity prices. क्या क्या factors है जो prices को impact करते हैं electricity prices को, so that you will be able to involve more into the product. Just before that, I would like to show you this one disclaimer. I just wanted you all to understand this, that this particular session will be completely educational purpose only. So there will be no financial recommendations or any kind of promotion of the financial products, derivatives or the services. And also any external websites that we use during the session will be only to help you understand how the to help you understand the product better, and we are not endorsing or promoting any of those websites. Well, and I request you all to please post your queries below in the chat box. We and our team will do our best to take up and answer as many questions as possible simultaneously. And I also request to restrict your questions only to commodities alone. And we'll be having a research analyst also if you have any price related queries to answer them. Well, with that, without further delay, we will enter into the session. And over to you, ma'am. I give away the platform to you. I request you to please share your presentation and help our audience understand what electricity is. And since most of our audience are retail audience, I'll help you. It'll help them understand how to trade into the market and how to, even for new joiners, even those who are first timers into the commodities market, even they will be able to understand this electricity is better. Over to you, ma'am.
Good afternoon, everyone. Thank you so much, Arvind. And at the outset, thank you so much, ICICI Securities, for giving us an opportunity to be able to create awareness and further education on this new product, a very new product for the Indian markets, that is electricity futures. And just the disclaimer points which Arvind just pointed out, the same goes from MCX side also. So there is no professional advice onto this and no investment advice that we are giving it. This seminar is purely from education and awareness purposes. So going on to what, just trying to understand before we go to the electricity futures, what is India's electricity market structure today? So Indian power markets today are divided into basically three on the basis of the term contracts. This is basically from wholesale market concept. So there's long-term market, there is a medium-term market, there is a short-term market. Long-term market consists generally of the PPAs which have been entered for 25 years. So those are the PPAs which industrial and commercial consumers do enter to receive electricity. And then there are medium term, which is 1 to 5 years. And a recent trend more is on the short term markets, which is less than or equal to 1 year. And within the short term markets also, there are two components. One is the bilateral. So bilateral contract, which we enter into, which the parties or the consumers enter into with the generators or the discoms to get the electricity, and the other is exchange traded. So in India, there are three spot exchanges which are regulated under CRC. Now, these exchanges actually trade on the day ahead market is one of the contracts which they trade, and there are different members, there are different parties or the value chain participants who go on these markets, but these markets are for 100% delivery basis. That's the market or the spot exchanges, power spot exchanges. Now, what is happening on a gradual increase is the shift from long term to short term is clearly visible in the Indian markets. As we also see, these power exchanges transactions are actually growing at a CAGR of over between 8 to 10% CAGR. The transactions are growing on power exchanges. So, which means there is either a surplus or a deficit for which these participants are coming on the spot exchanges to either buy electricity or sell electricity. Now, when you ever trade in a short-term market, there is always an uncertainty thing. And whenever there's an uncertainty means there is a risk. And if there is a risk, we need to manage those risks. Now, in electricity markets, the major risk is the electricity prices risk. Now, the demand supply, yes, there can be some shortages, but overall, the electricity power markets shortages seen are very less from the perspective of industrial houses. And that is why the uncertainty which is visible is mostly in the spot market. So if we go ahead and just see these numbers from long term, so from FY09 to FY24, the transition clearly says how the short-term markets have grown from 6% to 15%, of which today 8% is a market of the exchange traded market. And these exchange traded markets, the spot price volatility, if you consider it on an annualized basis on 30-day rolling, it's for 2024 has been around 19%. So just imagine with this kind of volatility. So when this, while power is a commodity which everybody has to consume, everybody consumes, and we cannot avoid that. So when this price volatility is there, there are certain risks that are arising. These are the merchant risk. It can be a short-term risk. It can be a long-term PPAs risk. So the need for electricity derivatives has risen in the Indian markets, and now with the regulators, both SEBI and CRC, have approved the derivative contracts. They have approved the electricity futures, and MCX had the privilege of launching these contracts in this month on the 10th of July. And these electricity futures can really help the value chain participants to manage this price volatility, what we are talking of around 20%. So while they manage this volatility, it will help them to manage their portfolios, the asset portfolios, because when you are say, just taking an example, when you are on a generation side, there are different types of generation mechanisms which you can use, which can be your gas based, your thermal based, or your other renewable based. So the entire portfolio can be optimized, managing your price risk. This helps to create or reduce uncertainty of your revenues and also your costs. And once you are able to manage your budgeted costs, this means you will be able to manage your profitability margins also, and overall leading to sustainable companies over a longer period of time. So these are the major benefits which electricity futures bring to Indian markets. And electricity is one such peculiar commodity which cannot be stored, we all understand, but this is also a very domestic commodity, because the fundamentals or the price impacts which we see on this commodity prices are very domestic in nature. So there are certain other commodities which, if the companies want, they can go abroad and hedge on the other international exchanges or OTC markets. But this is one such product where it can be hedged only in Indian markets because the prices are very peculiar. Now, if we pick up the prices of Europe markets or US markets, the electricity prices are very different from the prices which exist in Indian markets. So very domestic product for Indian market participants after a very long point in time. And this electricity derivatives, it is going to have a unique participant mix. Now, one side, we all understand in a derivative market is a combination of different types of participants which exist. On one side, there are value chain participants who will be here to manage the price risk. And who are the value chain participants in this electricity supply chain? So in this supply chain, we will have obviously the power generators, which include renewable generators also. We will have discoms or our utility companies. Then we will have industrial consumers, commercial consumers, and yes, the power traders. Now, the entire this section is here to manage the price risk, which we talked about. On the other side, to fill in this liquidity, there is a set of participants who are always there in any other commodity derivatives also. So these are the algo traders or our financial institutions and fund houses, our proprietary desks, retail investors, who will be the liquidity providers, and they have the trading opportunity over here. So the entire set together will make this an efficient and a robust market. Now, before we understand how electricity futures or the contract is going to, just going back to how the spot markets are, because these spot markets are going to be the underlying for our futures. Now, for MCX electricity futures, IEX day-ahead market prices, IEX day-ahead market will be the underlying for our electricity futures. And how this day-ahead market operates? Now, day-ahead market operates 24/7 and 365 days of the year. Now, what happens is when your day-ahead means you are trading today to get the delivery of the electricity the next day. So tomorrow. So for tomorrow's bidding will happen today. It's an auction market. A 1 hour bidding session is held for 15-minute blocks of next day. So that means total 96 blocks, the sessions are held for every 15 minutes bids. The aggregate supply and demand curves are drawn out of this. Now this price auction bids are based on volume maximization. So volume maximization is a principle. So the market clearing price which comes out is based on the maximum volume that can be traded at that price based on the bids received. And if we go into this cycle, so it starts from say 9:30 in the morning. Today 9:30 in the morning, the session is starting for tomorrow. This is entirely on the IEX day-ahead market we are talking. So 9:30, the initial margin checks and all happen at the exchange. 10 to 11 is the bidding session. It's a closed double side bidding session. So all the bids can be provided for the 96 blocks. Then 11 to 11:45, the exchange, the spot exchange calculates the market clearing price, market clearing volume based on volume maximization principle. Now, all these bids are then sent to Grid India, because Grid India or the infrastructure really plays a very important part in electricity supply chain, because we all understand electricity cannot be stored. So as it is being produced, it is consumed. So all these bids are sent to Grid India, where Grid India has to confirm that availability of the grid. There is no congestion or anything in that area. Post that, it will confirm back the bids which can be delivered, the electricity can be delivered to the exchange. So after this final receiving from the Grid India or the NLDC, finally the exchange comes out, the spot exchange comes out with its obligation file, declaring who all are the buyers, sellers, what is the price, what is the volume traded, which will get delivered the next day. So this is the day ahead market process flow or the entire timeline structure. And then of all these 96 blocks, now in this 96 blocks, there is a price which is being for every 15 minutes. A simple average of all these 96 blocks is called as the unconstrained market clearing price, which the spot exchanges declare on their website between around 1 to 3 p.m. on a daily basis, depending on their confirmation they receive from NLDC or some. Then they declare this price. Now, this UMCP, the unconstrained market clearing price, becomes the underlying for our MCX electricity futures contracts. Now, just going ahead, how the volatility or the impact is visible. Now, this is we have tried to plot for the July prices, the unconstrained market clearing price, UMCP for IEX DAM. So if we see the price movement, this price movement or the volatility of the price is clearly visible. Now, there are multiple factors which we will run through. Some of them, if we just visible here, the price reached a peak of around 5,773. Now, why this happened in a single day was mainly because that day there was a major fall in the renewable energy supply. And we all understand when there's a decrease in the supply side, the price will tend to go up. On the other hand, there was a day, it was a Sunday, generally the demand is low on a Sunday, but this was unusual because on the supply side, the supply increased a lot because the increase in the wind supply was there. So renewable energy supply increased. But on the other hand, the demand went down because the northern areas of India received heavy rainfall and there was low air conditioning usage. So the demand clearly fell down. Besides the industrial demand, which really falls down on a Sunday, the residential demand also fell down and the supply increased and the prices dipped. So this chart particularly shows what's the need of electricity futures. When you're facing this day in, day out, the companies at residences, we may not really realize this impact on a daily basis, but the industries, the commercial users, all our data centers come, these prices really impact their businesses. So the need for managing or hedging this price risk. And while we have seen this graph, upward movement, downward movement, there are multiple factors. There are multiple factors which together influence these electricity prices. A major factors can be, yes, the fuel cost. So the cost, yes, because it can be gas based, it can be coal based, it is renewable energy, generators are there. So basically, what is the input cost for them? So that will ultimately impact the prices. Then there is a renewable supply. Now, India is transitioning towards green energy. And yes, with this transition, renewable energy today, we do not have a commercially viable storage available for even for renewable energy. We may have the batteries, but they are not commercially viable at a big size. So there are periods where the renewable energy supply is going to be high. Now, when we have solar energy, so solar energy peak hours. So when the solar energy supply is high, that impacts the prices during those hours. But towards the night, the solar energy goes away. So that impacts the prices. So prices generally tend to increase towards the evening or the midnight. On the other hand, we all understand in the monsoon season, we have a hydro supply. So definitely when the hydro supply is supplementing your coal-based or thermal power, the supply will be more, so prices are more stable. So on the other hand, then or the macro fundamentals don't get complete without the demand side also. Supply is one side, demand. So demand can be from the two sides. Yes, industrial demand. So the timings when the industrial demands are low, generally maybe the weekends or certain industrial belts have a particular day as of on the in those industrial belts the prices get impacted. Then there can be our national holidays. So these all impact your demand. Consumer demand is more impacted also from the festival season. Generally, basis we have seen, I'll show you in some graphs. We see as September, October, there's a festival season which starts off, kicks off in India. So the demand generally rises in those seasons. And then, yes, there are summer peaks. So in northern region or south, sometimes very huge, or even in our western belt, we will observe a very bad summer peak season. So naturally, the demand will go up, and the demand goes up, supply cannot match, the prices are impacted. Then there is a certain seasonality which I talked of. Seasonality and weather is one of the major factors which impacts the prices. So as we have different seasons, so hydro, whether it is summers, whether it is winters, the impact is clearly visible in the prices. And if even if when we study historically, the impact can be clearly shown. And then yes, there are power plant shutdowns. So there are particular belts in which power plants are planned. It can be planned shutdowns. It can be exigency shutdowns also. And then there are transmission constraints. But today our infrastructure in power sector is very well developed, and we generally do not see a lot of transmission constraints or the cancellation of the bids happening on the spot due to transmission constraints. And now all these prices when they impact. So as a participant, if you want to understand from where you get the data sources, there are different government portals, there are some private sector portals, some of them being national power portal. Now national power portal generally has your how much is the coal stock available, what are the coal prices, or so that can be looked into from there. Then Vidyut Prava is one such website which indicates how much is the demand on electricity side, how much demand was met, what was the historical, so how much, what is the price today, what was yesterday's price, the different regions getting impacted in India. So then yes, we have the Grid India website. Grid India website will also, Grid India, IMD, weather forecast, they will actually let you know what's the weather forecast for say a week ahead or something. And when we know, suppose we know, yes, the rainfall is going to be very high or it's going to be sunny day, we can interpret what is going to be the impact on the electricity prices. Then yes, definitely the spot exchange, the Indian Energy Exchange website. Therein you get your day ahead market, how the prices are there, how every 15-minute blocks prices, how this UMCP is calculated and this there. And it also is general other, they have other different markets as well. So they have the real time market, they have the green time market. Those market prices can be looked into to understand how this price movement or how these markets are going to operate. Just even our MCX website. Now, if you go on MCX India website, we have under the product section, energy section, we have a separate power data analytics section. Now that section gives you, it is on real time telling you IEX DAM prices it is showing. So you can see it slot wise. These are the different slots on a particular day. You can select a date wise. So in that, when you go to the date wise, you can observe a different cycle along how the entire cycle of prices has been during the entire month or a day. And then IEX RTM real-time market is a separate market. This is not a futures market, but yes, this can give you an indication how the prices are moving. This can help you understand how the price movement is going to be, because these power prices are really dynamic on the spot exchanges. Then you have the yes, demand and supply. So consumption, what has been a consumption on the daily basis, and then how this is being supplied through different. So you have the different sources of power. So thermal, hydro, so solar, nuclear. So all that and how much variation we see. If you observe in this chart, there are different times when the dips are visible. And on these dips, if you go back and check the prices, these impact the prices definitely. This is one of the charts is the seasonality impact chart. Now, as we said, there are different, in India, we all have different seasons. Plus, it's also an historic chart. So if we want to study this, if we see an historical pattern, that really matches for electricity more or so. It may not have 100% correlation, but yes, generally, whatever the trend is, that is observed in the seasons. So if you see, we have tried and plotted layer the prices which existed taking into account last 5 years prices and try to analyze the seasonality impact. And if we see their particular months, so Jan and Feb, generally, yes, it's a winter season. And as we move towards March, the peak season or summer season, the prices tend to go up. Winter season, very high winters is generally limited to the northern areas in India. If extreme winters, if we see, while the others may not have a very extreme winters where the heating requirement is too high, but summers is across India, and we see in during summers, April, May, June, the prices tend to be on a higher side. Then as we move June, July, we are moving, transitioning towards monsoon season. So as we transition, the temperatures fall overall. Plus, we also have more of hydro energy available. So the demand is low, supplies, and monsoon season generally observes a tapering down of the prices. And again, as the monsoon retreats and the hydropower by September, hydropower retreats back, then we have September, October festival season kicks in India, and the prices tend to go on the higher side. Towards the December end, why the prices, though it's a festival season, so Christmas, New Year celebration, yes, the demand is high, but generally December end, they are also planned outages for the plants, industrial plants. Most of they have planned outages in December. So when they have the planned, these are shut down for the maintenance purpose. So the demand is on the lower side, on the industrial side. So that is why we see a tapering impact. So this seasonality is one thing which is one of the major impacts visible on the prices, and this can be really looked into easily by through the different websites we have discussed. Now, while we have understood what's the need for electricity futures in India, who are going to be the participants, so how do you understand the pricing? So coming back to what is the contract design? Now, MCX electricity futures, we are going to have 4 contracts in one go. So it is a near month and 3-month ahead contracts. These are going to be the monthly expiry contracts. So every contract, it gets launched on the first business day of the launch month, and it trades for 4 months, and then expiry is 1 business day immediately preceding the last calendar day of the month. So suppose it is March month, so 31st March, so the contract will expire on 30th March at 12 p.m. Now, what is the reason behind it? Now, we all know it's a day-ahead market. Underlying is the day-ahead market. So the 31st August prices on the spot will get declared on 30th. And on 30th by around 1 to 3 p.m. it gets declared. So before these prices get declared for the 31st, our contract will end at 12 p.m. So that once you know the entire set of prices, there is no point in trading that futures contract. So the contract will expire before the last calendar day prices are out in the market. Now the price quote is rupees per megawatt hour, excluding all the general taxes and levies. Trading unit is particularly kept simple and small at 50 megawatt hours, because if we see there, not only the larger companies can hedge, it is also the SME, MSMEs or the small users who want to benefit from this market, they can also hedge. Now, if we look into 50 megawatt hours and average price, if we consider around 4,500, the contract size is just 2,25,000, a smaller contract size for all the participants to participate easily. Tick size is, yes, rupees 1 per megawatt hour. So the bids and vote come in the multiples of 1. Maximum allowable open position at an individual client level, it is 3 lakh megawatt hours. or 5% of market-wide open position, whichever is higher. For member level, it is 10 times of this. Now, this is a financially a cash settled product. And so and DDR, final settlement price. Now, final settlement price is volume weighted average of the DAM UMCP. So day ahead market, unconstrained market clearing price. Uska volume weighted average of all the calendar days of the expiring month. Now, let me explain this with an example because this is very important to understand. Now, if I go on to this, suppose I'm just giving it's a March month. So it's just for an illustrative purpose, all these prices. So March, we have MCV, the market cleared volume, unconstrained, that comes on IEX website. So 1st March, the volume cleared was 1,61,997. That day's UMCP was 4,218. Now we actually collect all these prices and the volumes. These are multiplied for volume weighted average. So MCV into UMCP of each day, the sum total of all this 447. So sum total, sum of all the products divided by sum of the weights. So this comes to 4472 and 4472 becomes the DDR if the contract was a March 25 contract. So that's the volume weighted average of IEX DAM UMCPs for all the calendar days of the expiry month. Please note the word all the calendar days of the expiry month. So while we have understood, let me show you this with an example how it can be used. Now, just illustrative purpose, suppose there is a generator. Now, for a generator, say this generator signs a. Now, for one thing notable is this market shall be useful for hedging not only for the participants who participate in the spot markets or the spot exchanges, also for the participants who have entered into PPS. Because PPAs are fixed with fixed pricing. And whenever there's a fixed pricing, you are open to the vagaries of the price movement. So even for the PPAs, this market is useful for hedging purpose. So now I'm just giving it, suppose it's a generator. Now a generator signs a power purchase agreement, say in March 25, for giving delivery of 100 megawatt hours in May 25. For the one month of May 25, they have to deliver 100 megawatt hours at rupees 5,000 per megawatt hour. Now, if the generator, it's a physical market operating as is, it's an unhedged generator, does not do any hedge or anything, what happens? 1st April, they are preparing the budget for this, so they prepare it at 5,000 per megawatt hour. May month comes, they have to fulfill their obligation. They keep supplying, the generator supplies the electricity and at a rate of 5,000 per megawatt hour during entire month. What is the impact? Now, suppose during this month of May, while they're supplying, the prices on 1st April hit at 100 into 5,000. But by the end of May, the prices go up to rupees 6,000 per megawatt. Now, we may say, yes, the generator may have actually accounted for its profit, whatever margins they want, and they would have supplied at 5,000. But when you're existing in this competitive market, there is always an opportunity loss. So while the prices went up to 6,000, this generator could not do anything but fulfill his commitment at 5,000, and therefore it was facing a 1,000 rupees per megawatt hour notional loss or the business opportunity loss for this generator. Now, on the other side, we see there is a futures market available. So the generator decides to hedge his prices. Now, generator, the physical side or the PPA will operate as is basis. Only that when he locks in his contract, PPA enters into the contract, it will go and lock in its prices on the futures market. Suppose he buys a MCX electricity futures contract. So while the prices, so the spot price was 5,000, which moved to 6,000. So futures price is generally higher than that. So suppose the price was 550. 5,500 and it moved to 6,400. So if the generator has locked the price at 6,400 and with the generator locked the price at 5,500, and when the prices move to 6,400 and his contract has ended, PPA contract, he closes out his position on the futures market. So ultimately, the impact is he's making a savings due to hedging of a differential of this. So 900 per megawatt hour. The net to net impact, if we see, is if he's unhedged, he's having a business opportunity loss of 1,000 per megawatt hour. If he is hedged on futures, he's having a business opportunity just 100 per megawatt hour. So he was able to reduce his band of opportunity loss, and while fulfilling his PPA or his contract, also he was able to maintain his margins on the book. Now we go to suppose a consumer end. Now suppose there's an end consumer. We all consume electricity, industrial houses, everywhere electricity is used. Even you pick up a small industry, they will use. Now, as an industrial consumer, suppose I have a factory, I know my monthly consumption is around 50 megawatt hours. Now that monthly consumption, I generally buy it from the spot market every day. Now, if I'm an unhedged, I'm going ahead and unhedged scenario. What can be a scenario A? I budgeted, suppose 1st April, I budgeted my cost 50 megawatt hours into say average price I know is 4,500 megawatt hours. But during this period, I am consuming every day, I'm consuming electricity. But during this period, when I go to the spot, the prices actually increase. There can be multiple factors for that. Prices went as high as 6,000. So what's an impact on me? Impact is I have an additional cost to incur. My input cost goes up. The consumption cost goes up, which naturally impacts my total profitability also. So when my cost goes up, my cost is, how much is the cost gone up by? It's gone up by 1,500 per megawatt hour, which can be a huge impact on any industry. Now, on the other hand, there is a futures market available. I decide I am going to hedge. So while I keep procuring from the spot because I have to take delivery, I have also logged in a futures contract. I have hedged on the futures contract. I buy a contract, and that time if we see, suppose prices existed at 5,000. During this month, prices did go up to 7,000, but when I close, so I make a savings. What is the impact in the derivative market is, I am due to hedging, I have made a saving of 2,000 per megawatt hour. So what is the final impact? In the spot, I was having, when I was in a unhedged position, I was facing 1,500 per megawatt hour additional cost to incur. When I'm hedged, so 2,000 rupees I'm gaining minus the net impact of 1,500 increase in the cost, I have a gain of 500 per megawatt hour. That's my net position. So ultimately, due to hedge, I was able to create manage my both the sides. So generators were trying to reduce their uncertainty on the revenue side. As a consumer, was trying to reduce the uncertainty on the or the costing side, on the input costs. So that's a benefit. Price risk management is one of the need of this hour. While these derivative markets, as we discussed, will have multiple market participants, it is not restricted only to this, but yes, there will be financial institutions, financial retail users who can use these markets and benefit from these markets. Thank you so much.
Right. That was an interesting deck of information, ma'am. To the existing list of commodities that are already available with us at MCX, electricity, one more commodity that will help our retail investors to easily relate to. Like gold and silver are one of those contracts that they can easily relate to, follow the prices and take their positions. And they can also relate to these petrol and diesel prices so that they can trade in, take positions in crude oil or the natural gas and such electricity, such energy commodities. So now there is one more such commodity, electricity, that we can directly relate to. And this is for the viewers. Every month, the electricity bills that you pay, you'll be able to see those number of units consumed, the price varying in different bills, and there is slab wise prices per unit mentioned based on different electricity providers. So as ma'am was mentioning, the lot size, the trading unit for this electricity contract is 50 megawatt hour. So this 50 megawatt hour will help cater to all kinds of participants, like starting from retail participants to corporates, and even distributors who will be providing electricity to different consumers. Even all such kind of participants will be able to make use of this particular contract. And I just wanted for you all to relate to properly. I just wanted to show just one slide to understand this 50 megawatt hour. In your electricity bills you will be seeing in terms of units, correct? So this is 50 megawatt hour contract. So 1 megawatt hour is nothing but 1000 kilowatt hours, and 1 kilowatt hour is nothing but 1 unit. So the units consumed that you see in your electricity bills is nothing but 1 kilowatt hour, which is 1 unit. So 50 megawatt hours will become 50,000 units. So just for you to understand, if you are normally on an average, Indian households consume somewhere between 150 to 200 units per month. It varies widely, moving from urban to rural to urban areas. In bigger houses where there are like 3 4 bedroom houses, you have ACs in all rooms, multiple electronic equipments. They might use as high as 300 400 units as well. But towards rural regions, there might be households who are consuming even less than 50 units per month. So that's a wide range. But however, so just for you to understand and relate to what this lot size, how much it is, if you are consuming about 150 200 units per month, the lot size here is 50,000 units that expire every month. And that's how it is able to cater to all kinds of participants that want to come into this market. That is one. And also, ma'am was trying to explain this spot market particularly, which is the day ahead market. So this day ahead market or spot market prices, we can follow them from multiple websites. There is this Indian Energy Exchange website as well that you can use to follow these prices as well. I'll just quickly show you how you'll be able to see those prices. I just entered into this Indian Energy Exchange iexindia.com site, and at the top under market data we can see this day ahead market. So this exactly is what ma'am was explaining some time back. So these are those 15-minute intervals. So given 24 hours within a day, if you divide it into 15-minute intervals, there will be total 96 intervals. So for each 15-minute interval, there will be bids and asks that will be traded between 10 and 11, as ma'am showed in the slide. So against each of that particular 15-minute interval, there is this MCP price that is finalized. So all this that we are seeing, our prices will be the prices for next day. The prices are usually traded for next day. So that's why towards the end of the contract expires 1 day prior to the last calendar day. It's not the last trading day, 1 day prior to the last calendar day. So if at all there was a contract for this particular month, July. So for even today's prices would have been traded yesterday in the spot market. And that's why yesterday itself, if there was a future contract that would have been expired yesterday. But however, since at MCX we are launched on 10th of July, just this month, the first contract that will be expiring on in the month of August. So in the month of August, the last calendar day is 31st of August, which is on Sunday. So one working day prior to that, which is 29th of August, is when the first electricity contract will expire on the exchange site, on the MCX. So parallelly,
Arvind, just
yes.
1 sec, please be on that side. I'll just adding to it. Yeah, so this is the MCP, the last column which you are showing. This is for 90 each 15-minute blocks. So out of this, a UMCP is calculated. When you average out, simple average out across all these prices of 96 blocks, you get the unconstrained market clearing price. So just Arvind, go up now once in that. Yes, so this is a summary. So when you get the summary here, which the average price, the last one, 31st July, just observe the last line. So last row 2695.80. So this is the UMCP. So this is the underlying which we take for every day for the futures contract.
Right.
Yeah.
Right. Because unlike other commodities, gold and silver, or even the other crude natural gas commodities, India is primarily a price taker. That is, we follow the prices from international exchanges. For gold and silver, we follow COMEX prices. For crude oil or natural gas, we'd be following NYMEX prices. And from those prices, we'll be deriving by using dollar INR exchange price, by converting it and adding other taxes. We'll be trading that prices in India. Right. But this electricity contract particularly, we are following the spot market of India alone, because as ma'am was saying, in the international prices, there'll be a lot of difference of how much we are being charged here and what is in the international markets. So for this particular electricity energy contract alone, the underlying spot market is within the Indian spot market itself. And this is one website that you can follow to understand this UMCP for every day. So everyday prices are shown here. 15-minute interval prices are also shown here. And ma'am, I just wanted one more. I had one more query that I wanted you to answer.
Yes.
Under this market data, there is also this real-time market that you had once
Yes.
mentioned in your
Yes.
presentation. So may I maybe understand what this exactly means, and what is the difference
Yeah.
between
So
DAM and
this,
real-time?
yes, yes. So day ahead market. So day ahead market is the regulator to start off with. Is permitted right now in futures is the base load round the clock contract, base load RTC contract, which is a plain vanilla contract, which can be used across by entire participant section. Now, so that is why this is the day ahead market which comes on now for the entire 24-day supply. Now, RTM market is what the real time market is. Real time means now there are different auction timings for this, and within next 1.5 hours, you can take the delivery of that contract electricity supply. So it's a very real term coming in for a very exigency situations, a very huge, because see, as a generator, suppose I have electricity, I have generated electricity, so I cannot store it. So I'll have to inject it into the grid. So it's a real time I need to supply. So that is day ahead market. The basic difference is you're getting a bid, you're putting in auction bids today for getting delivery tomorrow. While real-time market is you are putting in bids right now for getting delivery after 1 hour now. 1.5 hour, you get the delivery. So that is the difference basically between the two markets.
Okay, so the MCX contract, the future prices that we see, that would consider only the DAM prices, correct?
Yes, yes, correct.
Okay. Well, let us also parallelly see on the MCX side. This is the mcxindia.com website. I've gone to this market data and market watch, under which I filtered out the electricity contract here. So currently, the August expiry contract is trading at around 4,483. So just for calculation purpose, let's understand 4,500 rupees per megawatt hour. And for 50 megawatt hour lot size, the approximate contract value would be around 2,25,000 rupees. So per megawatt hour, if the price is 4,500, and for 50 megawatt hour, the contract value would be about 2,25,000 rupees. And the margins for electricity futures is approximately 10%. Am I right, ma'am? Would it be 10%? Because in the launch calendar, that's what is particularly mentioned.
Oh, so launch currently they are 8% plus 1.25 is the ELM margin. So currently 9.25%. So this
8
actually
plus
bases the yes. So whatever the span runs is. So currently today it is around 9.25.
Okay. So for the viewers, so approximately 9.25% is what would be required from the exchange. And for different brokers, over and above 9.25%, there might be some buffer percentages, maybe or maybe not. So let's say approximately 10% margins is what required for 2,25,000 rupees contract. Approximately 22,500 is what you'll be providing per lot of electricity futures.
So Arvind, you can go to this product section once.
Sure.
I can show the analytics. So just go on the electricity page.
Right.
Yeah. So just yeah, this is the click here for electricity analytics section. So when you go, just accept that. Yeah. So this is the real graphs which we are showing, which generally are the impact points for the pricing. So IEX DAM prices, you can see slot wise, you can move between the slots, you can shift it to date. If you put the date wise, you will get the all across. So you are getting the MCV, market cleared volume. You are getting the average price, UMCP. You are getting the how the sell bids and purchase bids were. So if on a particular day sell bids are higher, naturally the prices will tend to change, impact, purchase bids. So that is one of the price which the users can actually view this to understand the price impact and how the movements can be. Then this is real-time market. It is just one of the factors to understand how the price movement can be for tomorrow, say. Because today it's happening so much, it may not be very different tomorrow. Consumption every day, so how much volume is traded, and then you have generation analytics are very useful because it is showing you the major dip. Sometimes there's a dip in the thermal, sometimes in hydro, solar. So every transition impacts the prices. So these are very useful graphs or the power data analytics which can be used by the users.
Right, right. So this is directly available on the mcxindia.com site itself. You just have to enter into the product section and select electricity. If you can click on this, if you expand this futures contract, you'll be able to see the contract specifications. So these are the contract specifications, contract duration, trading days. There's the price code, which is coded in per megawatt hour, 50 megawatt hour trading unit. And you can just scroll down for the electricity analytics here. All the charts you have seen here. So you have also been given this data sources where all these prices have been taken from. You'll be taken to IEX site, NPPC, or the Grid India sites as well. There is also an overview of this electricity futures below. So you can mainly important thing that I wanted to again highlight towards the end of the session is this factors influencing the market. Because since we're trying to relate to this electricity futures contract as we use it on a daily basis, it is also the fuel costs that are impacting the electricity prices, the weather conditions on during different seasonalities. There will be different consumptions. During the summer months, the consumption will be huge because of a lot of use of air conditioners and more of electricity appliances. The transmission constraints, renewable supplies, the consumer demand as well. During festival seasons, will be seeing a hike in the electricity prices. One of the charts ma'am was showing towards the months of September, October, there was a hike in the prices during the time of Indian where Indian festivals will be more in that time. Like Dasharaya, Diwali, and such Navratri and such festivals will be coming up in those particular months. So such festival months you'll be able to see price hikes, particularly in the electricity contracts. So these are some things you'll be able to relate to, so that while taking positions in this particular contract, you will be able to take well-informed decisions.
So and users can also, Arvind, just go down, or users can also download this electricity primer is there. They can click here and download, and it is a lot of useful information what the markets are, how the markets are operating in, and how globally the things are happening. So it's very useful. It can be very useful content to understand these markets well.
Correct. So there are a lot of information for you, the fundamentals information for you just available on the MCX site itself in the product page. So if you want to just explore more, you can go to other sites as well, like IEX that we had just covered. So there is enough information for you to first take complete fundamental information about the contract, and then take informed decisions while trading in the electricity futures. Well, thank you so much, ma'am, for taking out time to explain this product to our clients, to our audience today. I'm sure people will be able to understand the product. We are expecting more queries from our clients in the futures as well to take participation. And viewers, we hope we answered as many questions as possible that you had put in the chat box below. If you still have any queries, I request you to please contact the customer care number 1860-123-1122, or you can put your queries on helpdesk at ICICIdirect.com as well. We'll try and revert to you as soon as possible. Thank you so much, ma'am. Thank you.
Thank you so much, Arvind. Thank you so much, ICICI Securities. Thank you.
Investments in the securities market are subject to market risk. Read all the related documents carefully before investing.